I'm on the New York Stock Exchange floor with Keith Bliss, Senior Vice President at Cuttone & Company. Good to see you.
Thanks, Rhonda. Good to be with you.
Well, Tuesday morning is a lot different now than Monday morning. What's behind the buying that we're seeing today? Is it just a bounce back?
Well, I think it's a bounce back for sure, but it's going to be longer term in nature than you'll see most snapback rallies. Actually, on Friday, we caught the markets at one of our largest oversold technical levels that you can get inside of some of the models that we look at. And we saw that on the S&P 500 at 2017. Of course, yesterday we saw the S&P 500 trade below 1900 and stay there, but we think the markets have been vastly oversold. Any of the technical indicators that you look at with momentum or relative strength have pointed that out. I actually thought the bounce was going to come yesterday. On Friday, people didn't want to be long over the weekend, and I thought they were going to get a bounce. We didn't get the anticipated policy changes or remediation out of the Chinese government, and that left people still a little uncertain. But yeah, I think this is something that can be sustainable. It's just not a quick bounce. It won't be a dead cat bounce, as we say, pardon the expression. And I dare say that we'll probably see the S&P 500 by the time we get done with this trade, this little micro rally in here, probably get positive for the year.
So does this mean the U.S. now is separating what's happening in China from what's happening here? Because obviously the Chinese stock market reacted differently today.
Well, the Chinese stock market keeps reacting poorly because for the last 2 weeks, when you take a look at the intervention that the Chinese government did, not only in the equity markets, but also the devaluation of the yuan, I think people are pulling out of the Shanghai market because they're very uncertain about which direction it's going to go. And as you know, inside of any kind of market, if you have uncertainty, you have a lot of participants that will just leave and will not come back, so they'll take their money out. The U.S. market will still stay focused on what's happening in China from an economic perspective. I don't think the market, what's happening inside of their equity markets, will play so much into what's happening inside of the U.S. equity markets, insofar as their market is not reflecting what's happening inside the Chinese economy. So there are other things that we look at when we try to relate what's China's impact is going to be on the global economy and therefore on the U.S. markets. And in large measure, those are outside of the gyrations that you see inside of the Shanghai market.
But I wonder, even with this bounce back, and even if it's sustained, as you said, will we now see more volatility in the market? Because sometimes we go through these periods of increased volatility.
Yeah, absolutely. We should have, everybody knows the summer season is typically slow, although it was much more active this year. So you're starting to see the buildup in volatility. You've started to see the VIX, which is the volatility index measure, kind of hang around at levels where we knew it wanted to break out. The other thing that people forget is that when the U.S. went into quantitative easing and extraordinary monetary policies in 2009-2010, the markets were very volatile as we entered into those policy prescriptions, where they're going to be volatile as we come out of them. So the other thing that you have playing right now is you have U.S. monetary policy moving in an opposite direction from the rest of the world. So the rest of the world is not lining up with the largest economy in the world, in the globe right now. That's going to create volatility. The other thing that I've told clients and people to be thoughtful about is that we're about to enter into a typically very volatile season of the year. September and October. October grabs all the headlines because of the sell-offs that we've had over the years in the stock market, but September is typically a down month. So people need to be wary, need to be aware of what's happening, keep some powder dry, as we say, and just be able to maneuver in and out of the markets if they want. If they're longer-term investors and they're at an age where it really doesn't matter, I would say just turn off the TV and don't pay attention to the headlines. Of course, everybody's interested in the equity market. But you're going to get these volatile spikes. Let the professionals handle it. They'll do what's right for you, and we'll just move on. But in large measure, to your original question, is yes, expect more volatility throughout 2015, particularly as the Fed toys around with their monetary policy, and into the beginning of 2016. Could be fun some days, could be painful others.
We'll keep the seatbelts on. Keith Bliss, thanks so much. I'm Rhonda Schaffler for TheStreet.